So right there and say piecemeal acquisition arises. Piecemeal acquisition arises when the parent company obtains additional shareholdings in the parent, in the subsidiary, not subsidiary per se, in the investee, additional shareholdings in the investee company. Additional shareholdings in the investee company. Full stop. Another hyphen. The consolidated financial statements. The consolidated financial statements needs to be adjusted proportionately. To take into consideration the additional shareholdings. Full stop. Another tukiandika paragraphs 10. What is required is what you have had here. This one here. That once you have topped up and just become a subsidiary, balance sheet, you take it in full and you check. By the way, what if, check here, this scenario, I don't know why Casneb are not very keen on this. What if initially, initially the parent was controlling 55%, then on 1st June, the way we have said, they topped up another 20%, which makes it to be 75. How will we consolidate for that company? P&L, how will we consolidate for the profit account? Okay, parent is there. What will happen to the subsidiary? What will happen? At half of the full. Before step, it was a subsidiary. After step, it is still a subsidiary. So full. You don't apportion. Even balance sheet. So what is affected if it was a subsidiary and if, after addition is still a subsidiary, what will be affected is only what? Only NCI. Because NCI, the P&L, you will check the profit for this period, in which case they were controlling 1%, 45. Then after that, they'll be controlling 1%, 25. So you just adjust for NCI. You say NCI for, you say this is 5 months. No, for 5 months, you take what percentage? 45. Then for 7 months, you take 25. So when it was a subsidiary, then they top up, then the only thing affected is the NCI, which I'm not even worried because I know that I can compute. So you are just safe with the ones which are required. Let's go to illustrations. So since they brought this in the syllabus, they have examined it twice, 2019 and 2021. Yes. So let's start with 2019. I'm not sure which 2019, which 2021, but I think May. In fact, write them so that, write for me there, May 2019. May 2019. Question 2. Then this other one, just give me a few minutes. This other one was 2021, I can remember. Before September. May 2021 as well. May 2021, yes. Also May 2021. This one is question 1. And the one for 2019 also, that was question 2. So this one was question 2. So those are the two, actually those are the two questions since Casneb borrowed from the CCA. They were not examining this before. So when they borrowed, they have brought it twice. So I don't think it's standing a very good chance actually of being examined by, provided you know disposal, you just take the opposite, but you have to check on it. So allow me to start with 2019, but we'll have to do those two questions to give you sufficient. So let's meet in 2019. Let's meet in 2019. 2019, where are you? May 2019, question 2, yes. So let us read. Let us read. It says, G Limited, a quoted company, operates in the manufacturing sector. It has investments in a number of companies. The following draft statement of financial position relates to G and its investee companies as of 30th September of 2018. So we have G, S, and A. Fine, no problem. Additional information number 1. On first, rule number 1, ukiona hiyo story kwa mtihani usishtuke, hakuna kitu serious hapo ndani. The things which are there, you just find they are things we are used to. What are we used to? Revaluation, goodwill, cash in transit. So you just find that the same things. So number 1, on 1st of October 2015, G acquired 80%. First of all, we are in which year? We are in which year? 2018. So on 1st October 2015, so 3 years ago, G acquired 80% of the ordinary shares of S for a cash consideration of 32.85 million. What is that 32.85? Purchase consideration, which is relevant in determining what? Correct. At the date of acquisition, the retained earnings of S stood at 1650 million, and the fair value of the identifiable net assets of S approximated their book value, except for an item of land which had a fair value of 175 million in excess of the carrying amount. And what is that 175? Very correct. The plant had a remaining economic useful life of how many years? 5 years. Are you not familiar with that note? Very familiar. Number 2, on 1st April 2014, now that is 4 years ago, G gained joint control over A Limited, having acquired 50%. Were they supposed to tell us 50% anymore? No. Why? They have already said what? Joint control. So if you have joint control, you're controlling 50%. So having acquired 50% of the ordinary shares for a cash consideration of 500 million, that is okay. At that date, the retained earnings of A amounted to 225. G account for its share of interest in A using the equity method in accordance with that one. On 1st April 2018, G Limited acquired a further, underline that one now, that is now the key issue, acquired a further 25% shareholdings in A. So making it to have what percentage? 75. Qualifying it to be correct. For additional cash consideration of 250 million, when the retained earnings of A amounted to 525. The fair value of the original investment in A, as at 1st April 2018, was 980. No fair value adjustment was necessary in respect of the business combination related to A. No fair value adjustment was necessary, meaning there was no fair value adjustment was necessary, meaning there was no revaluation. When they say no fair value adjustment, it means there is no revaluation. Number 3, the group policy is to measure non-controlling interest at fair value. Meaning, which method are you using for calculating goodwill? Full method. At the respective dates of acquisition, the non-controlling interest in S and A had a fair value of 200 million and 250 million respectively. That's okay. Goodwill of S and A were tested for impairment on 30th September 2018. There was no impairment relating to A. The recoverable amount of the net assets of A was 3480, no problem. G Limited sold inventory. What is loading? Sold inventory. What is loading? And realized what? Profit. G Limited sold inventory to S for 54 million at fair value. G reported a loss on the transaction of 9 million, and S still held a half of these goods in the inventory. Sour. On 1st of October 2017, G acquired patent rights for 45 million to use in a project to develop new products. G completed the investigative phase of the project, incurring an additional cost of 32 million, and determined that the project was feasible. Fine. An effective and working prototype was created at a cost of 18 million. And in order to put the product into a sellable condition, a further 14 million was spent. Finally, marketing cost of 9 million were incurred. All of the above costs are included, and then there are included in the intangible assets of G. Now that is quite general. What the examiner is checking, do you know what is called capital and revenue expenditure? Because the incurred cost, marketing cost. Are you supposed to, including those costs as part of cost of the asset means you are capitalizing. Capitalization means you are recognizing that one as part of what? Assets. Are you supposed to recognize part of marketing cost as cost of the asset? It's a record of vitabu. No. So the examiner is trying to check which costs should be capitalized and which one should not be capitalized. So we'll separate them. Like prototype, in your view, prototype cost, should we capitalize that one? Yes. Demos, for you to develop a product, hata kama ni ndege, si unatengeneza kakitu inakaa ndege, then you come up now with the plane itself. So we'll check which ones were supposed to be and which ones were not supposed to be. So required, Roman 1 required, determine determine the amount of what? Goodwill arising on acquisition after the impairment review. So in that case, many people are anti-goodwill. So Apple, lazima ufanye goodwill. Hata kama ulikuwa anti-goodwill, anything you are going to post in regards to goodwill will add you marks. So make sure unaifanya. Then consolidated statement of financial position of G in accordance with fine. So let's kick off. What is serious here? No. Let's start. Goodwill. So because we have been doing goodwill so many times, even in exam, you can tell the examiner, recall. Recall, what is the formula? Consideration done what? Consideration paid, not just the purchase consideration, minus what? Net assets done what? Net assets acquired. Ubaya umeandika recall na ukaandika formula na ukastop hapo. So there was no need of recalling. We have started. So now we want to, they have said we compute for both S and A. Both S and A. So let's check S limited and also let's check which one? A limited here. What you need to know and appreciate with a lot of concern is that A, you compute the goodwill after the step what? Acquisition. That is when it became a subsidiary. So, even the fair value. Can we have fair value in a joint, fair value of NCI in joint venture? In joint venture, hakuna NCI. NCI exists when it is a subsidiary. So when determining goodwill, kindly compute goodwill after it became a subsidiary, not when it was a joint venture. So you will pass when it was a joint venture, you know. Check when it was a subsidiary. So consideration paid, which some people will call purchase consideration, some people will call cost of investment, whichever name you want to call it, give us here. So consideration paid. How much did parent pay to acquire S? I think not one. For a cash consideration of how much? 32.80. Give us there. The problem we have with A, kidogo to 32.85, sure. 32.85. A kidogo. A, but let's go back to A. A initially, check where the sentence started. On 1st April, G gained joint control over A, having acquired 50% of ordinary shares for a cash consideration of how much? 500. That is when they acquired the 50%. But now when it became a subsidiary, listen to what they were saying. And we check where there was the top up. On 1st April 2018, G acquired a further 25% in A for an additional cash of how much? To 50. When the retained earnings was that. The fair value of the original investment was 500. So the fair value of the original investment in A as at 1st April 2018 when they were topping up was 980. So that company, of course, the investment which you will have will be 980 plus what you are required to top up. Because initially they paid 500, but when they are topping up, the value of this 500 is now how much? 980. So you take 980 plus the 250. That is the value of that company right now. When you want to sell it to somebody, if you were to sell, but then for you to understand it better, you invested 500. If you are to sell it to someone, not you, gaining more control. If you are to dispose it to someone else, you will dispose it at how much? 500 still? No, at the current market value, which is how much? 980. So the value of the company is 980 plus what you are required to top up. How much is this? 12. Can you help us with the fair value of the makers? Fair value of NCI. So if fair value of NCI is there, we assume that is what they invested in the company. How much? They were given somewhere, note number? Number 3, yeah? Check note 3. The group policy is to measure the non-controlling interest at fair value. At the respective dates of acquisition, the non-controlling interest in S and A were valued at 250. So you add this, you add this one here. So this is 34.85. This one is 14.80. Correct. Then you can cross it off. You can call it X. Then we less the net assets. How do we get net assets? We take equity components. Yes, which are the equity components? Ordinary share capital, share premium, retained earnings, and revaluation. So go to equity in the balance sheet. You just go to the equity in the balance sheet. We have ordinary share capital of S and A. Are you seeing the 1,000? And 900. Share premium 160, 90. Retained earnings, which retained earnings do we use? On the date of acquisition. You know these two, they don't change, but profit, goodwill is computed on acquisition. So can you go to where they were acquired and check the retained earnings? For A, you check when it became a subsidiary. You check the profit on that date. So in note 1, what was the retained earnings when we acquired S? 1650. Then when we acquired A as a subsidiary, in that note 2, what was the retained earnings after the top up? When the retained earnings was 20 what? 25. Sure. Yes, I hope you can see it in notes too. Then there was revaluation. You remember? Yes, revaluation is also an equity component, and it was there on the date of acquisition. So revaluation note 1, how much was the revaluation? 175. Nothing. Can you add? Add for me this. Then once you add, we call it Y. We call it Y. Who was for S? 15, 15. 15, 15. Huh? Oh, that's for A. Oh, how about 2000? So H 15, 15. How about S? Which is which? Why is that in our online? 3285. 3285. How about A? 15, 15. Yeah. Oh. Now, goodwill will be the difference. So goodwill will be X minus Y. We have copied what someone has said. It is 2985. Yes. So Elizabeth, 2985. 2985. So goodwill will be the difference between the consideration and the net asset. So can you subtract? It's as easy as that, imagine. Yes. Not number 2. Atumekupiga na butwa. Okay, I can narrow it down for you. Are you comfortable with the fair value of NCI being 250? Yes, sir. You don't have a problem with that. Where do we have NCI? Do we have NCI in joint ventures? NCI only exists in subsidiaries. So it means you compute goodwill when this company became what? A subsidiary. So the items you are considering is when it became a subsidiary. Because even you have topped up, you have stepped up the investment. So you cannot go to the original then. So you check retained earnings, revaluation after. So good. So goodwill is how much? 500. Negative 35. See maajabu kupata negative. We will not impair negative goodwill. Negative goodwill is an income. Eh? Yes, negative goodwill is a capital reserve. So there was impairment. Prayers ikifika, you let me know. There was impairment I had somewhere. Check note 4. Check note 4. Goodwill of S and A was tested for impairment. There was no impairment to A, which is obvious. Even if we would have said it was impaired by 10%, you can't impair negative goodwill. Negative goodwill means you have paid less, you have bargained. What class to bargain? Yes. Yes, you can bargain. You cannot bargain. Ukiambiwa ni 8,000. Hata hiyo shati ukiambiwa ni 8,000. So here we bargain. So this one you don't impair. Then continue. The recoverable amount of the net assets of S was 3480. Was 3480. So these people have failed to give us the impairment. Instead they are telling us the recoverable what amount. Then read required. That required again. You have to determine the goodwill arising on acquisition of S and A after the impairment. So you have to subtract impairment. Less impairment Impairment loss. So the examiner is not good. They have refused to give us impairment. Instead, in note 4, they are giving us recoverable amount. So I will use recoverable to get impairment. So Farida is requesting that we pray for 5 minutes, then we come back. So let's pray. Then we come, we compute our impairment. So, yeah. So can you, he doesn't have notes. Can you take care of him? And remember, you are accountant. Nothing is for free. So atakusaidia. He was here day 1. In fact, he alikuja 2 weeks before to the classes.
Pana huyu huyu namwona sawa, nitamwambia. Hata mkono chako kama umekauka mnakula kimoja. Naweza kwenda kuivisha after class. I don't have a I don't. No. What's that? I don't do this. I don't
All right, so people have really prayed. We go to, I want us to calculate impairment. We were not given, they gave us a lot of stories instead of giving us impairment. So let's have an outside working for impairment loss. So I want us to calculate impairment loss, which they are denying us. So how do you calculate impairment? You will know that the asset is impaired, impairment loss. Asset is impaired if the book value which you are calling what? Carrying what? When the carrying amount of the asset is more than the recoverable amount. Recoverable amount. Book value, you have recorded 50, but the best you can get from that asset is 30. It means the asset has lost what? Value. So the examiner gave us in note number 3, not number 4, the recoverable amount of the net. Sum up of Missouri. You are given the recoverable amount of net what? Net assets. What are net assets? Net assets is the assets minus liabilities, which is simply the equity. Sure. So when did they assess impairment? So that I should know when to check the net assets. 30th September 2018, which is the close of the year. Sure. Yes. So I want us to get this carrying amount. So give me the net assets. Net assets on 30th September 2018. That is at the end of the year. So just pick, instead of listing all the assets and liabilities, complete waste of time, just take the equity components. They are representative of the net assets. So ordinary share capital, but I'll bring the ones which were not part of the equity. I'll bring them in. Ordinary share capital, we are dealing with which company? S. So ordinary is what? 1. Share premium. Share premium. That is 100 and what? 60. That is 160. Then retained earnings. Now it is at the end of the year, not opening. Retained earnings This is 19. Do you remember there was revaluation? There was revaluation, but the problem, that revaluation surplus was supposed to be depreciated. It was when? Check, that revaluation was when? When the subsidiary was acquired. A subsidiary was acquired in 2015. So it has depreciated for 16, 17, 18. For how many years? 3. So you will take 175. It was 175 but minus the accumulated depreciation. Useful life was how many years? Divide by 5 times how many years? 3 years. Depreciation is for 3 years. So take 175 minus this because it was being depreciated. How much? 70. So something which will get you with a lot of surprise here. This one here. We have determined goodwill to be 500. When? When have we determined this goodwill? As at when? When is that goodwill? When is that goodwill? It's in 2015. Goodwill is computed on the date of what? Acquisition. And impairment has been assessed in 2018. So it means as part of the assets, goodwill should be part of the what? The assets. But you see, you cannot see it up here. This equity are representative of the assets you can see minus the liabilities. So the ones which you cannot be able to see, bring them here. Goodwill is also part of the assets. So goodwill on the date of acquisition is 500. It's part of the assets. So that is the one someone can really forget very fast. Why am I adding goodwill? Goodwill is an asset, and the ordinary share premium and retained earnings, these three are representative of what you can see, the assets you can see and the liabilities. Revaluation, you cannot be able to see it there because they are not consolidated. Goodwill also has not been captured, but it was part of the assets. So our total net assets will be how much? 36. So that is the carrying amount. Carrying amount is 3630 less what? Recoverable. Recoverable amount. How much is the recoverable amount? You are given 3480. Therefore, the difference, the book value is 36, what we can recover is 34. It means the asset is impaired. So impairment loss is how much? How much is impairment? 150. So that is what the examiner wanted us to check. So go back there. Under evaluation, is it 2 years or 3 years? It is 2 or 3. When was S acquired? Because the revaluation was on the date of acquisition, October 2015 to 2016, 17, 18 is also included because what? So the first October 2015 goes to September 2016. Then 16 goes to 17. Then 17 goes to 18. It is 3 years. It is 3 years. Hope you have seen. So impairment loss 150. Meaning that net goodwill after impairment, net goodwill, that is what? 350. So Joyce, I hope you have seen the 3 not 2. So how many months? 6. So 6 months will be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Because if we combine them, then any 12. No, not any. There are 12. 12 at what? Half. So the ticks you get half. Nobody will mark the goodwill figure. The entries are what we mark. So that is 6 months. Let's go to the balance sheet. But before balance sheet, I want us to analyze. We check the financial period. What was a subsidiary for how many months? Those stories which you are used to. So let me present it here. So can you have that number line? We check what happened. Initially, we had 50%. After acquisition, we have 75%. So have this one here. Before we start consolidation, because that is what is going to guide us to know how to consolidate. So the year is ending when? 30th of September 2018. That one must start on 1st October 2017. Sure. So let's analyze those two subsidiaries. One, when was S acquired? S. Before we go to A, when was S acquired? October 2015. It means S is a full year what? Full year subsidiary. It was there at the beginning of the year. It was acquired in 2015. So when we were starting 2018, 2017, 2018 financial year, it was already there. Next, A. A was acquired when, let's start with when it was acquired, because sometimes maybe it was acquired within the year. Then again, they step acquired during the same year. So first of all, let's check when was it acquired. Then we go and check the step acquisition. So when was A acquired? Block number 2, eh? So April 2014. That is a long time ago. So when we started, A was present. So when did we top up additional shareholdings? 1st April 2018. 1st April 2018 is somewhere here. 1st April 2018. So that is when we topped up. It was 50%. We topped up what percentage? 25, making it to be 75%. So it will be a subsidiary from this period. So A is a subsidiary for how many months? 6 months. Hakuna cha 9 minus 4. Nahesabu vizuri kwa mkono. If it was started April 7. Kama ni 30th? Yes. Kama ingekuwa 30th April ni 7 months. Na ikiwa first ni 6. Kama hapa ingekuwa 30th. Then it means April not included. You count from May. So be very keen with the months. So 1st April inclusive. So 6 months. So A is equals to 6 months. 6 months what? Joint venture, because we had 50. Then 6 months what? Subsidiary. Correct. So allow me, tell me. In the question, I've seen the examiner saying we prepare only the balance sheet. What if the examiner required also the profit account? Because they can bring the same question, but now you go in a P&L. So how are we going to do the consolidated statement of P&L? Assuming P&L was required. So we'll add which ones? G, the parent, plus S, plus A bar, 6/12. So all the income and the expenses of A, 6 months. But which 6 months? This 6 or because the job of them 6 like you 6 that because whichever 6 you take, it will still be fine. So which 6? This one or this one? Yes, this one here. This one here. This 6. What about the one which we have been requested to prepare? Consolidated statement of financial position. It will be G S plus A in full. Balance sheet is never portion. So this is the heartbeat of the question. This one here. You ukishajua hiyo story ushapita. Hiyo story yote umeenda tukienda huko what. This is where the question is. What if, though I don't want to take you back there, what if it was disposed? They disposed and they remain with 50. On disposal, you take the pre-disposal periods. No, before it became, because what disposed the in a joint venture and associate. So if it is disposal, you check from beginning up to that date. But if it is step, you check from that date going forward. So let's start. Actually, start. This one. This is the key issue. You knowing that now A will be taken in full without any problem. So let's kick off. However, even if it is in full, there are some things which you must apportion. You see things like depreciation. The items of expenses, which you need to adjust, you must take 6 over what? 12. But the assets and liabilities in full. Let's kick off. Right there, G group. Then you are going to attempt for me this one before tomorrow. The other question. There were 2. So you will attempt that other one. So, right there, G group, consolidated statement of financial position. What we are doing here now is just a waste of time. Heartbeat of the question is there. No matter what, so here there is no issue. As at 30th September 2018. So let's maintain one column. You can maintain 2 if you want. So non-current assets, let's just copy your balance sheet out, but now we consolidate all of the 3 ESA. So non-current assets, we have PPE, property, plant and equipment, and 4140, 1350, 1395. Was there revaluation? Yes, revaluation was there, but remember it has been depreciated. So is there any crime you will do when you add here 70? You can imagine 70. Yes, or it was 175. It was being depreciated for how many years?
5 years.
5 years. And it has depreciated for how many years? 3. Do you know there's no problem if you say this? You are aware? It has depreciated for 3 years. So the value you are remaining with is for how many years? 2. Instead of taking 175 minus 175 over 5 times 3. Is this one giving you 70 by the 2 over 5 times 175?
Yes.
Yes. So, or you just add 70 if you don't want stress. So 70 is the 175 minus the accumulated depreciation. What do you get when you adjust everything? 60? 69, 55. Okay. Next, intangible assets. Intangible assets, I have a problem with them. Intangible assets. So intangible assets, we have 891 plus 540 plus 158, subject to note number 6. Let's read that note. Let's read that note. On 1st of October G acquired patent rights for shillings 45. I want us to analyze those figures because there are some we are going to disallow. So patent rights for 45 million to use in a project to develop a new product. G completed the investigative phase of the project, incurring an additional cost of 32. So 32 na underline na investigative cost. So there is investigative cost 32, and determined that the project was feasible, fine. An effective and working prototype was created at a cost of 18. So on line 18 and the prototype issue. And in order to put the product into a sellable condition, a further 14 million was spent. So on line 14 and the sellable condition. Finally, marketing costs of 9 million and another 9 million and marketing were incurred. All of the above costs are included in the intangible what? Assets. So there are some costs which should not form part of the cost of the asset. Ama?
Yes.
Like which ones? Marketing cost. At una market product which you are launching. Then that cost you capitalize and you depreciate. Will it make sense? You amortize. At ukienda ununulie watu soda, kuja muone kitu mimi nimetengeneza, and that is also part of the cost of the asset. No. That one, kwanza hiyo ndio starting kabisa. No, that marketing cost. There is one, actually two. There is one I'm seeing there. The rest are okay. There's another one. Which value? 14. Where's the 14? Hey, that one is serious. Cost you incur to put the asset into sellable condition. That is a capital expenditure. That is a capital expenditure. Cost you incur to bring the asset or to make the asset in sellable condition is a capital expenditure. Because for you to, there are some assets for you to sell them, you must take them to the market. Those are, that one you have to capitalize. The one you need not to is this investigative phase. That one, your feasibility, that one you can't capitalize. You ukicheza nayo, G Limited completed the investigative phase of the project, incurring an additional cost of 32. You cannot capitalize investigative cost. We can investigate back next year. What will per DM? The rest we can capitalize. The acquisition cost of 45 is okay. Prototype is okay. Which other one? Sellable condition is okay. Investigative we can't capitalize. 32. Wacha tuende tukiuliza watu kama hiyo kitu ni mzuri. Wapi? Si unaenda unauliza hata uendi unaandika tu kwa status, please can somebody tell me, then unarudi kwa office unasema I've incurred 200,000 to ask people these questions along Moi Avenue, Kenyatta Avenue, and everywhere to lie. So that one you can't capitalize. How much is that? 1548. Then investment in S and A, investment in subsidiaries, you don't bring them in consolidation. Those are intercompany investment to replace with goodwill. Apparently, goodwill in A was negative. So sikuja hapo weke ati negative here hapana. Negative goodwill is a capital reserve. You can credit it to retain earnings. So goodwill you only give me for S. The one we got in S after impairment. It was 350. How much do we get? 88.53. Next, current assets, inventories. Inventories, we have 1102, 819, 414. What do we normally subtract? In any group accounting inventory, what do we normally subtract? The unrealized profit. Can you search for it and calculate for me how much is unrealized profit? It was in which note? Not number 5. Can you calculate? Because you people are very serious when it comes to UPI. You have never gone wrong. So can you calculate it today as well? We calculate. Just calculate and tell us how much. Or what is always the formula? Profit margin times the unsold goods. No, I apply there, then you tell me how much. Why are you laughing? Hakuna unrealized profit in that question. See, wamesema they sold at a loss. So the people, the neighbor pretending to be calculating is calculating unrealized loss. Hakuna kitu kama unrealized loss. So there is no unrealized profit here. There is no UPI is the unrealized profit on inventory. It is not there. From the beginning, they sold at a loss. So that is better for us. So don't calculate unrealized profit on loss. How much is this? Leo wamepiga chenga, si ndio? Neighbor amepata answer. How possible? How much is this? 23.35. Next, receivables. Okay, by extension, in the inventories, in a maximum 2 items. UPI, then there is one which is very rare. What is this? Which is adjusted here. Goods in transit. If they are there, you add to inventories. Then you subtract them from receivable. So receivables, 2016 plus 891 plus 486 minus, what do we normally subtract? Intergroup debts. Mara, someone was owing some power. It was not in this question. Intergroup debts. Intergroup debts. So can you adjust for that? So what is difficult in that question? We knowing that we are supposed to add the 3 of them. What is the intention of that examiner? How much is this? 93. Okay. Cash and cash equivalents. You are wasting time writing those cash and cash equivalents. Cash. They will not even read what you have written. It's the composition. Yes, cash 909 plus 450 plus 190 plus tunaongezaka nini hapo? CIT. Cash in what? Transit, which was absent. 1549. So total assets. So can you add all of them? 10 for 402. Kuna mali umekosea? Wanasema hapana. Copy at your own risk. Yes, it can, because ikiangalia 8 and copy at your own risk. Charles. That was, I think, that was the total for.
I thought we were 15.
Oh, sawa. But what to make a consolation statement? Furthermore, nobody marks those totals. So if entries are okay, total ada unaweza chora mtu hapo, there is no problem. Ordinary share capital. Ordinary share capital. How much is this? Parent only, 41. 4140. Share premium, parent only. What is difficult here? 329. Ama ile karatasi ya customer inashtuanga mtu. Oh, wale kwa white. Retained earnings. Retained earnings. A story for another day. Those are serious workers. Hata kwa mtihani uache. Ukipata time, rudi relax na. Usipopata time umalize na hujapata time ya kurudi. That is an indication that kumbe ungeifanya. Ungekosa time ya kufanya hizo zingine kufanya. And it will just waste your time. Itakuzungusha tu bure. So there's no need. But hapa lazima tufanye. NCI, that is also working. Things which are making our life difficult don't work. Now, let's proceed. We finish others, then we come back. In exam, don't come back unless you are sure. Non-current liabilities. Imagine the most difficult thing in that question. The most difficult thing is you knowing that you are consolidating from the three. Otherwise, once you know the three, unasema sasa, and you want everything. Come on, Azim. Everything. Ordinary pekake unapiga break. Non-current liabilities, we have 8% debentures. That is 1640 plus 288 plus 333. How much? Hmm? 2261. Deferred tax. Deferred tax, we have 1187, 265, 243. Then there is nothing. How much? How much is that? 1685. But why are people normally ukisikia watu wakiongelea vibaya group? That thing is dangerous. Hapa kuna kitu dangerous. Can you even compare this with ile sababu tulikuwa tunafanya high school street kuna gari ile inatoka street na nyingine train. Ile waka train.
But mwalimu, those are not coming from alliance.
Hii ilikuwa alliance. Be honest. So adding you and calculator mkiadi hizi vitu tatu. Hata ile za high school inashinda yeye. Ama unakumbuka ile hesabu? Sijui velocity. 16? This one is easy. Just addition. But once you interpret, but let's just be honest. Interpretation again. Zini moja tu yenye unafaa ujue sahi. Once it has become a subsidiary, balance sheet, hata tusiende hiyo farm. Balance sheet is never done what? A portion. If it is a joint venture or a associate, at the end of the year, don't bring it in the balance sheet. If it's a subsidiary at the end of the year, bring everything. So that is the rule. So shida iko hapo. Unless you are creating more problems for yourself. I know where the problem comes. Either someone swali imekuwa rahisi mpaka unashtuka. Unasema, is this me really doing these things? Ama there are things. Mpaka kama mko kwa exam na Charles unaangalia, is Charles writing very fast? Mkiona Charles ameshikilia kichwa unasema this thing is hard. I'm the one rushes. Let's go slow. They are easy. Actually, what you have said is the truth. This question, not this question, all group questions is all about interpretation. How you interpret the concept. So payables. Payables comes to 92. 92. Tax. 516. Then we assume that we have always been accurate. You say 16.1. and 30. Full stop. How many marks? 14. This is 14 marks. On the yes. 1, 2, 3, 4, 5, 6. On the extreme part, that things are very dangerous. People have really passed, which is very rare. People have really passed. What we over 80 and 90 in Afra, the worst case scenario is that this one they will give 14 at 1. 14 at 1. You say you want to Peter, so they are trying to reduce. That is the worst scenario it can be. Otherwise, you need 7 ticks here to sail through. But wakiona watu wamepita sana at 14 at 1. When you're 14, able to mark. Let's check before we struggle here. See whoever interprets correctly. This one is okay. This one is okay. This one is okay. This one is okay. Premium is okay. This is okay. This one is fine, fine, fine. What do I say? So without struggling, without thinking of 50, a student should get comfortable. 1, 2, 3, 4, 5, 6, 7, 8, 9. Kwani ukipata 9 over 14 na goodwill pia mtatoka bure ama pale kwa goodwill utatoka tu bure hata purchase consideration au post. Out of those 6, I know the least you will get there is 3. And ukipata 12 over 20 without thinking, you say bye. On a normal, because this thing must be moderated, normal 1, 2, 3, 9. Utakuwa umeshapata 7. This thing should be 7 and 2. Utapata 14. Wachana hizi vitu mbili. Hizo return earnings. You know, ubaya watu wasikiani. Utasikia mtu after exam. Ni return earnings ndio imetia time. Sikufanya segmental. Who say? You know, okay, kama wewe ni perfectionist, ukiona umepost hizo vitu vizuri, perfectionist unajua hataki kuacha vitu blank. Kuja uandike hapa 2301 679 umefunga macho na uende kwa hiyo swali. At least zimejaa. Already you know umepita hii. So why do you waste time? Wacha na hizo vitu, they will just waste your time. Hata mtu atakuwa number 1 mwenye anapewa award. Hata kwa amepata hizo vitu vingi. I'm telling you the truth. So nikipata award, what will you give me? Give me that. Who should give the other person? Who should reward the other one? Let's do this one. Let's start with the NCI's equity. NCI's equity. We have S and A. We want to know the capital of the minority shareholders, those noise makers. It can bring you a lot of problems. So on the date of acquisition, check how much was their market share. Their market share in quotes is their capital on that date. That is their capital on that particular date. I can remember 200 and 250. The fair value of NCI, you remember? Yeah, fair value on acquisition or at acquisition, whichever. Their fair value is their capital on that date. That is what they can claim. This one was 200, this one was 250. That was on acquisition. Then they argue anything which will come up in that subsidiary after acquisition, please give us our percentage. Here, NCI are claiming what percentage? 20. Here they will claim what percentage? 25. Sure. So any profit generated after, you give them. Ile munaitanga post acquisition. So you come here and say, add post acquisition. But you have appreciated group is wide. Yeah. Post acquisition profits. So post acquisition profit in S, you will give them 20%. 20%. How do we get post? Hapo tu ndio watu wanapoteleanga na is post you check the today's profit. When is today? When is today? 30th September 2018. So check the profit in the balance sheet. Balance sheet is the one prepared at the end. So check the retained earnings in the balance sheet. Then you subtract the profit which was there on the date of acquisition. Then that difference is what they made after. So how much is appearing in the balance sheet for S? 19.
Yes.
So this is 19 minus when we acquired in note 1. How much was the retained earnings? 1650. So when we were acquiring them, profit was 1650. Right now, 19. So that is what that company made after acquisition. Give minority their share. They will not make noise. They are the good people if you deal with them accordingly. How much is that? 50. Okay. What about A? A, I'll give them 25%. Check the balance sheet. 6, 25. Then you check, now there are sometimes confusion. Check the retained earnings when it became a subsidiary, because we are in NCI exists when there is a subsidiary. So check the profit when it became a subsidiary. It was 5 something. In note 2, paragraph, note 2, 520 what? 525. So they made 100 after acquisition. 25% of that is 25. In S, there were 2 things which NCI must suffer. I want you to tell me those 2 things. There are 2 things which they must be responsible to. There was impairment. So you tell them, your impairment. Why are we subtracting impairment? It was full method. They participated in goodwill determination. They must also be responsible for impairment. So impairment, yes, please.
On that acquisition for A.
For A.
Yes.
Yes.
The 525 is supposed to be after acquisition.
On the date of acquisition.
On the date of acquisition.
Yes. When it became a subsidiary, because you know NCI was not there when it was.
When it became a subsidiary.
Yes, when it became a subsidiary. So
It became a subsidiary.
First of
April.
Yeah, yes.
And it's written there, the retained earnings of A. 525.
525, sour, good. So impairment loss was 150.
Yes.
150. Minority will suffer 20% of that 150. However, if it was partial means there was no fair value on acquisition, please don't disturb NCI. They are minority anymore. How much? 30. There was depreciation, right? There was depreciation. Depreciation, I remember it was 175 divided by how many years? 5. Times 3 times 20. It was in the books of S. So that depreciation, they have to suffer for all those years. However, if we were doing it for purposes of P&L, you only multiply 1 year because P&L is year-based. Yes, so you don't accumulate. But balance sheet, you accumulate the impairment, the depreciation, sorry. How much is that? They are suffering how much? 175 divided by 5 times 3 is 105. 105 by 20? 21. Fisher, hakuna kitu ingine hapo. UPI absent. What? 199 to 275 total. Because we have to get FCI as 1. 474. You know what you're supposed to do? Give me the retained earnings as the balancing figure. Then we check, and that is it. So NCI 474. Can you insert retained earnings? Then we confirm. Actually, the reason that's why now for this NCI, I think for 3 reasons. One, because that's the NCI is required. That one happened. Why would you do those things? Utatatiza aje na wewe pia utatatiza na hivi. How? Okay. And furthermore, the job good NCI. Ile tu when labda students who are going to pursue SCCA after this, SCCA inakuwa kama required. It's required. With them, they don't require the full presentation. This is to go goodwill, get retained earnings, get NCI, so at least you will have concept. And also, ndio jina yangu isiharibike ati ule juma wa fix NCI as balancing figure. Otherwise, kama ingekuwa watu wa campus hakuna shida. Walimu we are good. Tusonge mbele, si lazima balance. So retained earnings when you try to fix it is how much? So that we confirm. 40? 44? 23. 44, 23. Kisha, let's confirm, then we are done. In exam, Mungu akitembea na wewe mpaka hapo, hakuna kuconfirm. So, retained earnings, let's confirm. If we can get the same, then that is better for us. So retained earnings at the end of the year. So for the parent, pick the one at the end. End is the one appearing in the balance sheet. Then for the investee companies, you take post-acquisition. Why post-acquisition? The one which was on date of acquisition, they took when they were calculating what? Goodwill. So you take what came after. So you take for, it's called G. Carried down is the one in the balance sheet. So can you check for me G in the balance sheet? Their retained earnings. 40, 28. 40, 28. Then for the subsidiaries, you add post-acquisition. So add what they made after acquisition. Post-acquisition profits. So let me start with S. Minority, already they have taken 20%, parent will take 80. So post the same way we did MCI, closing in the balance sheet minus on acquisition. Balance sheet retained earnings of S is 1900 minus on acquisition it was 1650. So parent will go home with how much? 200. 200. Okay. A parent was controlling 75. 75%. What they made after will be 625 minus when they became a subsidiary at 525, 175. Yes. Before I forget, do you remember there was negative goodwill somewhere? Like again what like this is the story big. Yeah, begin to have an add Add negative goodwill. Negative goodwill is income. You paid less than what you acquired. 35. And then the two, impairment, depreciation. Let's share here. So less impairment, impairment loss. Impairment was 150. Minority died with 20. Parent should take what percentage? 80. 80 of 150. Not that one. How much? 120. Then there was depreciation. Depreciation was 175 divided by how many years? 5 years times 3 years times 80. This was 105. This one was giving us 105. So just take 80% of 105. Okay. 84. Eh? Yes. Subtract even this one, you should subtract. There is something, don't go to. Yeah. Wait, there is this issue. Check non-current assets. Check for me non-current assets. In the non-current assets, how much are you seeing as investment in A at the end of the year? 900. So the book value of investment is 900. However, how much did we initially invest in A? The initial, when it was joint venture. So it was 500. It was 500, but the date you are topping up, that 500, its market value was currently how much? 980. Then again, we were requested to top up another additional of how much? 50. So it means the market value of that company, you got 1230. Wait, 1230. So the market value of the company is 1230, and even that's what we consider a goodwill computation. But the book value of investment, they are saying is how much? 900. That gain goes to the parent. So you add other government that cannot be here, that's the truth. Fair value increase. Fair value increase in investment. It is in investment or on investment. Whichever. Fair value increase in investment in A Limited. Right now, the market value is 980 plus 250 minus the book value, which is 900. So there's a fair value increase of how much? 330. Is there? Yes, there is one item. You remember the expenses which we subtracted from intangible assets? Why were we subtracting them? Because they are revenue expenses. They are not capital expenses. So you revenue expenses you subtract from retained profit. I don't have space right down there. Less revenue expenses or revenue expenditure. There were two, 32 plus 9. 32 plus 9. There were two of them, the investigative, and the other one was marketing. So 32 plus 9 is for tuition. 41, subtract. Can you check to confirm whether we are in order? Okay. Oh, you are working slowly. Okay, that's right. So how much is that? 44? 23. Good. So our next question for step, which will be the last, we said which one? I want you to go and check. So someone will pay answers. Just go and go through.
May 2021.
May
2021. Question 1.
Question 1. Yes. You know, we can cross-check, by the way. This is May 2021. May 2021, they brought step acquisition. What? 2019. May 2021, it was step. What about November 2021? A good check for me, something which we must have done. December 2021. Not pilot paper, but the sitting itself. I know it's something we have done here because Kama nisome tu jina, ilikuwa inajiita nani? Kama ni kina Pareto. Ndio.
Kulikuwa na Pareto. Before that,
Kulikuwa na September.
yes.
Oh yeah, before this there was September.
Yes.
I remember, yeah. September 2021 was Gina. I also want to hear Gina. I think we did it as well.
H limited acquired percentage materials.
No, have you done that question? It was what? Normal. Yeah, it was a normal one. Normal means it is not foreign, it is not disposal, it is not step. The group 2 evil. I know. So this one was normal. I want to check the trend. It was normal, I remember.
Yes, normal.
What? If you can't stay qualified, this sitting here is a sitting which can never be forgotten. Eh? When you look at exam, kila mahali. When you look at exam, now we cancel so many students, so many. In fact, up to date, the students who have not gotten results from this sitting. When I come to you, I got meeting. This one was the worst. Then December 2021 was disposal. Eh? Yes, that was disposal. Then April 2022 was foreign. Eh? Foreign. Then August 2022, please check the trend. You know, group they are divided into 5. There is step, normal, disposal, foreign, and cash flow. But of those 5, cash flow you can buy the I'm mixing it out again. So these 4 wanachukua moja, but cash flow iko kando. We are headed to cash flow, so we are safe. So of the 4, the last 4 sittings: step, normal, disposal, foreign. So we are going back to high chances is there. So to be safe, know how to approach all. Anybody who can do step, can do disposal, can do foreign, can do what? Normal. So just know all, but I'm really suspecting this to my examiners. I don't know why I'm doing it. But so umejionea. So one point to make a question back. Can you take a step? For your information, si maajabu sana wakulete warudishe foreign, but you put foreign with the disposal. Foreign can be combined with any of these. No, it can be foreign with the disposal or foreign with step. It is possible. Kuna foreign huko mwisho lakini ya katikati was disposed. So check that question, we do it tomorrow. Hey, please let's before your time in Africa. Let's check ourselves. Let's do self-assessment. Blank. Let's check the time remaining vis-a-vis what we are remaining with. I want to check so that I can know whether we have a revision time for revise or not. Reconstruction, we are remaining with external. Sure. External on the highest side, 1, 2, 3. The highest side, I need 6 hours. Then we are remaining with EPS in full. EPS on the higher side, I need 8 hours. So how many classes are these? 3. 3 classes of 2 hours, 2 hours, 2 hours. Sunday we'll say these are 4 classes, 2 hours, 2 hours. There is impairment. Impairment as a topic is the last topic. Impairment remaining to Kenda's law, 6 hours, 3 classes. Then we are remaining with cash flow. Cash flow 6 hours, 3 classes. Those are what we are remaining with to cast them. So let's check what the time we have, so that I can know whether we are preparing for some small blocks of 1 day. So today is 4th. So tomorrow is. I want to check the time we are having because I'm stopping the classes on 24th.
Tomorrow is 5th.
Tomorrow is 5th. So 5th.
Then
5th.
Saturday.
Saturday.
Saturday the 9th.
Saturday is 9th. So this is normal. Normal means our normal class,
Yes.
without the combination.
Yes.
Then bring Sunday. Sunday of which day?
Sunday
10th.
Yes.
So 10th weka mara mbili, Silitapo.
Yes.
We get 2 classes. Then from there we come back to normal.
Come back to Monday.
Monday is 11. 12. Saturday
16.
16th.
Yes.
Sunday
17th.
17th. Monday
18th.
18th. And 19th. Then you Saturday yake.
Then 23rd.
Then 23rd.
Yes.
Then you Sunday 24th. 24th. Let me do distribution. So reconstruction. Wait fast. Kesho.
Yes.
So step in progress.
Yes.
So tomorrow we'll finish step. Then these three allocate for cash flow. Sure.
Yeah.
Yes. So cash flow. Then this Sunday, these Sundays, I need 3 for reconstruction. So reconstruction done. Then EPS, I need 4. So 1, 2, 3, 4. EPS. Impairment 3. 1, 2, 3. Impairment. Kila mtu apambane na hali yake. Yes, kama government wata confirm 11th to be holiday. If the government will confirm, tutaongeza moja, just +1, because sasa some tutakuja jioni, tutakuja during the day, but we might do 6 hours. So it might save us 1. So there's no time. Unless, we can still do it and do revision. Basa ile kuenda hapa cash flow tufanye swali moja. Kama ni moja ni 1 class is enough. So those many which nimeweka, swali ya kwanza nitakuwa nimefunza. The next 2 questions ni block revision. Kama step hii nimefunza, kesho ni blocks. That is how we are moving. It's not easy to teach within 3 months. Thank you. Let's meet tomorrow.
Thank you.